we are going to be focusing on candlestick anatomy. Candlestick anatomy. That's the, I think that's like the basic of the basic when it comes to trading. So candlestick anatomy. Let me write that. Candlestick anatomy. So so the basics of candlestick anatomy is, when you look at all of this is a monthly time frame. So each of these candles you are seeing is what we're going to be looking at the anatomy. And candlestick anatomy is having the understanding that just the same way we have to study the human body, that is the anatomy of the human body, to be able to understand how the human body works. The same way we are going to focus on the candlestick anatomy so that we're able to understand how the candles open, how they close, when you see the price action, so that we're able to understand what the market is doing at that particular time. Because the candlestick is actually what make this market what it is right now. You get so right now, um, if you look at it, we have the the green candles here, and then we have the red candles here. The green candles are indicating that the market is going up. If you look at it here, the red candles, as you can see, is indicating that the market is going down. So that is having an understanding of how these candles are formed. So this is a monthly time frame, but right now we're not actually focused on the time frame. What we want to look at is how it opens, how it moves, the top, the bottom, and how it closes. So let me start with a bullish candle now. For a bullish candle, this is how it forms. For a bullish candle, this is how it forms. So what you see is you see the candle open somewhere, and then it will usually go down, rally, form a high, then it will close somewhere. So now let me just draw a candle to make it more understandable. So you normally see a candle will open like this for a bullish candle. When we use the word bull, we are talking about a buy candle. That's a candle that is going up. So it will open, it will now go down, then go up, and then it will close. So, but basically, there's something called a wick. So this is it. So the candle opens, then it goes down to create a wick. This wick, then it goes up, and then it closes somewhere like this. Okay, so if I'm going to label this candle now for a bull candle or a buy candle, it's going to be like this. This is the open price. This is the low here, the low of the candle. This is the high of the candle. This is the high. Then this is where the candle closes. Close. Okay, I don't know. Okay, this is close. This is low. Excuse me. This is the low of the candle. This is the close of the candle. Okay, so you see, mostly what you see is you see the candle open, then it will go down. It will now form the high of the candle. then it will now come down and close. Now, this is why you end up seeing the candle like this. So this green candle you are seeing, if you look at it, you understand and see that it opened here, it went lower, went up, and then closed. So this is the opening price here. Here it is the opening price. This here is called the wick. This is wick, and this is the body. So let me label it here for you to be able to understand it. Okay. So this is the body of the candle. Body. This here is the wick. Let me take this out. So this is the wick. Here, we call it wick. Are we together? Let me just get a little feedback. I've been talking since. Let me just get a little feedback so that I know that we're on the same page.
Together, we are together.
Okay, it's understandable?
Yes.
All right. So as I said, for a bullish candle, you end up seeing the candle opening, then it goes down. It, now, this going down is to create the low of the candle, or they call it wick. So anything that forms below the candle here is the wick. It's not part of the body. Then anything that forms above the close is also the wick. So anything between the opening price and the closing price for a bullish candle is the body of the candle. I think we are good to go on that, right? So this is for a bullish scenario, or a candle that is a buy candle. This green candle we are seeing, all these green candles, any candle that goes up, it doesn't really matter the color. But any candle that goes up, that's how it forms. It will first of all open, then it will form the wick, then create the body, and then it will close. So this is a typical example of a bull candle or a bullish candle. Now let me give you an example for a bearish candle. So let me erase this and then give you an example for the bearish candle. Or let me just do it like this. I'll just edit it. So for the example for the bearish candle is like this. And based on what we're used to seeing a down candle to be red. So let me use a red color to indicate that this one is a bear candle. Okay. So for a bearish candle, the market will normally open here. It will open here. I'm going to illustrate it. Okay. So this is what you normally see for a bearish candle. That's a candle that goes down. It will open somewhere like here. Then it will form the wick of that candle. Then it will go down, probably form the low, and then it will close. So this is the major difference. But if you notice, the high for a bullish candle and low for a bullish candle is the same. The only difference is for a bearish candle, it will open, it will form the high, and then it will go down, form the low, and then it will close. You get the market will open for a bullish candle, it will open, it will form the low, it will rally, form the high, and then close somewhere around here. Meanwhile, for a bearish candle, it will open somewhere around here, it will form the high, go down, form the low, and then it will now close. So let's not forget, because moving forward, I'm going to be talking about certain concepts such as weak, this is the body. So sometimes I might say things like weak to body closure. So you should understand that this is what I'm talking about. Either this here or this here is the wick. So for a bullish candle and a bearish candle, the wick is the same thing. They all have wick. High for a bullish candle is the same as high for a bearish candle. Low for a bullish candle is the same thing as a low for a bearish candle. You get so this is basically um candlestick anatomy. This is you should understand the market from here. So let's go into live chart so that I can show you a couple of things uh, before we proceed into the next topic. So now look at this. Let me zoom this. You see, this is a bullish candle here. The market opened here, it went down, rallied and formed the high, and then went down and closed here. Now, there are certain situations when you will not obviously see a wick, like here. You see this bearish candle. There's a wick, but the wick is very, very little. So here, the market opened here because as you can see, it's a bearish candle. It's a red candle. So it opened here, then formed a very long wick, then went down, and then closed. Look at it, created this very small wick here, and then closed here. Then look at this one. It opened here, formed this wick. Look at see this wick here. It formed it. It rallied, formed this high, and then closed. So this basically how the candles function. So the more you are seeing green candles or bullish candles, it means that the candles are opening, going higher, and then closing. So this basically candlestick anatomy. So the next thing we are going to be looking at is in the absence of no question, the next thing we are going to be looking at is market structure. Market structure. Market structure is more like uh, okay, it's more like how the market moves. Market structure is how the market moves. The market is not, some people say the market is random, but in reality, market is not actually random. Market moves in three ways. The market is either moving in an upward direction or in a downward direction, or it is moving in a sideways direction. Okay. So now I'll take time and explain each of these structures for us to be able to understand it. So now the first one I said is a bullish market structure. Now earlier I said something. The same way candles either go up or they go down, the same way structure is also in the market. So it's more like in a situation where there are more bull candles, if there are more uh, buying candles in the market will tend to form a bullish market structure. If there are more bearish candles, the market will tend to form a bearish market structure. So let me give you a very good example. Now we said bull is when the market is buying, bear is when the market is selling. So a bullish market structure looks like this. It will go up. Now I'm going to also define what I'm doing here. So so basically, the market moves like the way it moves like in waves. So what the market is doing now is this a higher low. We call this a higher high. We call this a higher low, a higher high, a higher low, a higher high, a higher low, and a higher high. Now, what this is telling us is when the market is forming a higher high, higher low, higher high, higher low, is indicating that the market is bullish. It's essentially moving in an upward direction. So in a market like this, what you want to do is you want to look for more of buys in the market than sales in the market. So let me define it here. This is a higher high, higher high. This is a higher low, higher
from my
low.
end.
Okay.
Okay, I can hear you now.
All right. You want to hear me?
No, no,
Okay.
just for a few seconds or 1 minute.
Okay. Okay.
Can hear
So,
you.
all right, good. So this is a higher high. So this is a higher low. This this is our higher low. This this is our higher high. Okay. Then this is our higher low. Okay. So anytime you see a market structure like this, what you want to do is you will want to engage the market by buying it. Though you won't just buy at random, but essentially you are going to be doing more of buys than sells in a market structure like this. So we call this a bullish market structure. A bullish market structure is, if you want, you can be taking notes, though I'm recording this, but essentially this is a bullish market structure because the market is forming higher highs, bullish market structure. So essentially, the market is forming higher highs and higher lows, higher highs and higher lows. So it is actually, you can actually predict the market if the market is giving you this kind of signal. So this is a trend. So I think this is understandable. So let me go to the next market structure, which is the bearish market structure. The bearish market structure. Okay. So the same way the market forms higher highs and higher lows, when it comes to a bearish market, it's forming lower highs and lower lows. So I will explain it for a bearish market structure. So you see the market moving in waves like this. It's forming lower highs and lower lows, forming lower highs, lower lows, lower highs, and lower lows. You don't really need to, with time you understand the terminologies. So this is a lower high. Here, here, this is a lower low because the market is forming, is actually going down. So you see, they call this lower low because this low is actually lower than this lower high. So this is under lower high. This is a lower high. And then this is a lower low. This is a lower high. This is a lower low. So essentially, that's how the market moves. It's either it is forming higher highs, or it is forming lower highs and lower lows, or it is moving in a sideways direction. Okay. So so that's so this is your bearish market structure. So let me double it. Okay, I've already done that. So see it. So this is a bearish market structure. The market forming lower highs, lower lows, lower highs, lower lows, indicating that the candles in the market, we have more of sell candles than buy candles in the market. So essentially, we should be expecting more of sells than buys in the market at this particular time. Okay, let me quickly do the last one, which is the ranging or the consolidating market. I won't recommend that you trade in the ranging market because the noise in the ranging market is too much for a beginner to actually do well in. Though there are people that actually prefer to trade in a ranging market than in a bullish or a bearish market. So ranging is when the market is not forming higher highs or higher lows. It is basically just moving in a sideways direction like this. So in a situation like this, you only know what exactly the market is trying to do. But some people that trade this, they might want to sell somewhere around here, and then maybe buy somewhere around here. You get. But I personally will not advise that. It's better to be in a market where you can clearly see the trend, whether the trend is going higher or it is going lower. By that, you'll be able to anticipate it. Because in a ranging market, you won't really know when, maybe it's when you are trying to maybe sell around here that the market will just keep on buying. But in a market that is that trending higher or lower, you'll be able to anticipate it. You'll be able to know that, okay, there's a high chance that the market will continue going in that direction. You get. But in the ranging market, there is a lot of uncertainties. So that's why we always advise that you don't trade in a ranging market. So I think that's it for this session. If you have questions, you can let me know.